Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics and subjects looking for investment opportunities, and I share those opportunities with everyone in the community. The coupon code's in the lower left there, special. It's 50% off the first month only on a monthly membership and a larger discount on the yearly membership. And you can always switch from a monthly to a yearly membership if you like using that coupon. Cole Smead, I know some people, we've been talking about Cole Smead, and he's given his opinions about Canadian oil and gas. In his opinion, this is the second best buying opportunity of the last 20 years in his career in oil companies. Here's a great chart to give a picture to this. Barrels are a proxy of revenue, and rigs are a proxy of capex. So U.S. oil barrels per rig per day coming up through here, and it is a proxy of revenue and rigs. And right now, rigs and revenue are down. So in his opinion, second best buying opportunity, I would agree with that. The ratios agree with that. Let me pull up the ratio real quick for crude oil, or I should say gold to oil ratio, so you guys can see what he means by that. So he's stating that this is the second best opportunity to buy oil in the last 20 years. The best was here. That was 2020. The second best is here, which is where we are today. So from a ratio perspective, it is cheaper than any time in history going back to the 1980s. This is 1983 of March. We are way cheaper. This could be also a shoulder, head, shoulder in the ratio, which will eventually, I'm not saying immediately, but eventually work its way down over time. Could there still be a spike higher? There very well could be. We could even do kind of like one that does something like that. Not saying I know that this is the ultimate top, but what I'm saying is it's cheap. And generally, when something's cheap, it's good to buy it and then sit in it and wait for the sentiment to change. So yeah, he's right. Jordan Roy says, last Friday, silver broke out against the 60-40 portfolio in daily and weekly terms. It broke out from over a 4.5 year long base, highest close since September of 2020. This means that capital is starting to move out of conventional investments and into silver. And there is the 60-40 silver divided by the 60-40 portfolio, and it's starting to break through some resistance here. Now, these bottoms take time. We've been in this kind of roundish bottom here for about 10 years already. It's going to come on up and we're going to start to accelerate to the upside, where silver will start to accelerate its outperformance against the 60-40 portfolio as time goes on. That would be my guess when looking at this chart. There is an important horizontal red resistance line above us still that we still really need to punch through and get out of this bottoming formation. To me, this looks like a double bottom. Bottom one, bottom two, and then we'll punch through eventually. Renting is now significantly more affordable than buying a home by one of the widest gaps ever recorded. That's what this guy is saying. Ever recorded, really. So, smart real estate, if that data is accurate, then I would concur with your assessment. My homework suggests that it is not only inaccurate, but egregiously so. This is the most unaffordable time in history for owning versus rent affordability. What they did is they took this and only looked back a certain period of time, maybe to here. But there's actually worse locations like the late 70s, early 80s. That was much worse than what it is today, according versus the own versus rent ratio. Home affordability based on median family income. You can see where we're located. It was much worse in the 1970s and 80s. What's the driver of this? I'm sure a lot of people, what's driving this? It's demographics. The 1970s had the baby boomers coming through home buying years. Today, it's their kids, the millennials. I guess some millennials might be from Gen X, but most of the kids that are in the millennial group are baby boomer born. They have baby boomer parents. And this is rent affordability based on median family income. So that's rent affordability as the median family income. So that is expensive there. Worse affordability versus greater affordability. Trump, Bissett, and Powell eye high growth and high inflation era. So I think this is what they're trying to accomplish. This is what they want. This is what they're pushing for and striving for. Trump, Bissett, and Powell eye high growth, high inflation era. Washington retools the Reagan playbook as bond markets brace for a paradigm shift. A growing consensus is emerging among the top ranks of U.S. economic policymakers. 4% real growth and 4% inflation may not just be acceptable, that might be the new target. Treasury Secretary Scott Bessent installed earlier this year under President Donald Trump. Second administration has reportedly outlined a framework targeting 8 to 9% nominal GDP growth, seemingly a sharp departure from, I guess, previous administrations. What if they don't get that real growth, but what if they get a whole bunch of inflation? What kind of risk do they have about that? And 4% inflation, that's probably the adjusted inflation. I wonder what the real inflation is going to be. It's going to be like 10? We're going to target 10 with nominal GDP at 4? I don't know. We'll see. Rock bottom entries. Copper looks insanely explosive. So it's broken out through some resistance on the upper end here. And we're both lagging on top of it. So a lot of the times what occurs is you get a punch through on a big candle, you punch through it, and then you rest on top of it, consolidate. The consolidation is the bull flag, and then you punch away from it again. I was charting copper as well. That's what it looks like from this perspective. On the daily, and that's what he has, it's bull flagging on top. There's the flag right there. Another thing that I like to look at is the copper to gold ratio. Look at this thing. That looks explosive as all get out. And I don't know if you guys follow this, the copper to gold ratio. It doesn't seem like it's as popular as some of the other ones. But we're right at that resistance potential breakout here for copper. I don't know if we're going to punch through immediately, but it looks like it's trying. And if we get a large move of copper against gold here and move back to levels of, say, like 2006, I mean, that's going to be one heck of a repricing of copper. So what I like to do is I like to pair this chart, this ratio chart, where it's cheap against gold, and squeezing into a corner which is bullish for a break higher. I like to run that against what it's priced in dollars, and that's sitting on top of the pattern. That's about as bullish as you can get. And then we're going to flag out here and then rip. So I think copper, in the short term, this thing looks excellent. And it's coming from an excellent valuation for the sector from a historical basis. So again, these are the types of opportunities, guys, where you want to look for investments, maybe some copper equities. You get in them and you just sit. You just sit, you wait. We also see a nice little breakout here. This is probably wave 1, 2, This here is wave one of the bigger picture. And we went over this, and this is going to go, this is all wave three. So this is one of two in wave three. And this is wave, again, this is 1, 2, 3, 4, how it peaked there. And that was wave one and wave two. So the bottom of wave two was 2020 for copper. This was the breakout of it. And we're in wave three from Elliott wave perspective, in my opinion. There we go. Platinum versus the price of gold on the monthly here. It's up 5.18%, just as after the 2020 crash. This chart tells us we're headed to a historic melt up across sectors. Gold, silver, copper, uranium, crypto, lithium, and much more, oil included, and natural gas, don't worry. With 25 years in the markets, follow hedgehog trader. Yeah, platinum leading, gold precedes a melt up. I would agree. And there's been studies done on this, the platinum gold ratio and what outperformed. Stocks underperform, commodities outperform, inflation sensitive assets do. Against all odds, precious metals and industrials are leading the pack. This isn't a fluke, it's a rotation. Capital is flowing into the hardest, heaviest assets on the board. And I don't think it's done. The cycle is just getting started. Stay with strength, stay with metals, in his opinion. So let's see, what's the strongest? Palladium, platinum are up there for, this is 1 month asset price performance. Let me yank that down. 1 month asset performance. Platinum, I think, is leading the year-to-date performance. So palladium, platinum, Bitcoin, copper, silver, all the metals, just killing it. Heating oils up there. On the bottom here, we've got VIX, coffee, rough rice, soybean meal, corn, cocoa. These are all the soft commodities. We got natural gas in there too. Crude oil is down a little bit. So the metals are the outperformers here the past month. I think that will change in the future, though. I don't think. So here's another thing, guys. I mean, just kind of speaking freely here. What you're going to see is you're going to see a rotation between these, and these are going to flip back and forth throughout the bull market. They're going to have their time in the sun. They're going to accelerate to the upside. They're going to overperform for a period of time, and then you're going to get an underperformance. They're going to consolidate. And at the same time that's consolidating, we're going to see oil and other ones rip it, or coal, or whatever it is. It's good to be spread across all these different asset classes or sectors to steady the portfolio. It's a beautiful thing when your portfolio works together. You reduce volatility versus a one sector portfolio. So what a lot of people do, and this is what they try to do, they try to time the market sectors perfectly, and they end up jacking everything up. I'll explain. They'll try to time a sector, and let's say they go 100% into gold because it's been going up. But they should have gone in when the chart suggested it. They chased. So they put 100% in something that eventually ends up underperforming and consolidating for a while. Then they feel like it's not moving. So they go and they run and chase something else that goes up. But they should have bought the pattern, not chasing price performance. So really what they're doing is they're just running around chasing price performance and missing out on all of the gains that sector is basically providing. They're missing it. If you spread across multiple sectors, the asymmetry is what will carry you higher. So what I mean by that is if you're in one sector and one sector does this and then it consolidates, and another sector, when this basically starts to consolidate, starts to go up, and then that consolidates, they shift back and forth as one consolidates and one goes up. And you can have bigger pullbacks than what I'm drawing here. I'm just giving you the idea. It's the general concept. You get, maybe a falling wedge or some sort of flag pattern or whatever. And then your portfolio, even though you're going sideways in this one asset class, the size of the move from here to here will keep the portfolio, maybe your portfolio doesn't go up, it goes up like this as they go up. And then your portfolio does something like that versus the psychological pain if these were to pull back where you go up and then you get a sharp pullback like this. This is where people get really frustrated. This happened a lot with a lot of the uranium investors, I think. They went all in on uranium and then they get really frustrated on these big pullbacks, which uranium experiences, it experiences like all the other sectors. But at the same time, there were other asset classes that were going up higher, and then they peaked a little bit later. It could be energy service. It could be some of the energy exploration production companies. And then when that peaked in 2022, your precious metals guys started to go up. And then when you add this all up, you get a portfolio that it may underperform the peaks here, but you get a steady move that looks something like that all the way up. And the asymmetry of each sector is what's basically launching you higher. So even if you get a 50% pullback in one sector, the other one's going up multiple hundreds of percents. And that's how it works. That's how I would set up a portfolio. If you try to live through these pullbacks, they can be pretty rough. This is in a consolidation, but this pullback here can be pretty rough for some people, for a lot of people. U.S. diesel inventories are at their lowest level in 29 years. This follows a cold winter, which drained reserves. This is likely to worsen as refiners shift to process lighter crudes. Problems could emerge in coming months when diesel demand ramps up during harvest season, putting upward pressure on prices. Look how low we are. I mean, this is pretty low in millions of barrels. Freight futures AM update. Dry bulk is up. Capesize up 1%. Panamax up 3%. Tankers are also up. VLCC and Suezmax are both up 1%. Bitcoin inflows into ETFs have captured roughly 70% of gold's net inflows year to date, is what this is saying. It says gold had a head start in 25, but Bitcoin is catching up fast. 6 months into the year, Bitcoin ETFs have brought in 13.5 billion in net inflows compared to 19.2 billion for gold ETFs. It's a strong setup for hard assets overall, but Bitcoin is showing the stronger momentum. So that's net ETF year-to-date inflows, Bitcoin, Ethereum, and then gold. So it has perhaps stolen some from the gold investment, total dollars. But I think that's what it's designed to do. I think it's trying to steal from some of these hard asset sectors. Is it done on purpose? Was this set up on purpose? I don't know. Some people think it is, some people don't, which means that they set up an intangible asset to soak up liquidity out of the market and keep it from going into gold and other asset classes, which could be a good thing if you're in it and you get out. Could be a bad thing if you're stuck in it and it's a big, I don't know, a dud, if it turns into a bubble, so to speak. Novelism says if you eat, invest, and think according to what the news advocates, you'll end up nutritionally, financially, and morally bankrupt. Be careful what you're listening to and what the news advocates for you. What I found, I don't listen to the news, guys. I think news is just crap. It's just garbage for the most part. It is absolute trash. Hansa, let's see what this is going. We're going to read through this. It says something big is happening in the silver market and fast. Let's connect the dots. Over the past days, multiple signals have emerged that point to a massive shift in the silver landscape. What used to be boring, manipulated market is now heating up like never before. So let's go through it. Physical deliveries are exploding. On COMEX, silver deliveries just broke out. Nearly 2 million ounces per day, matching global daily production. Industries, investors, and shorts are now competing for metal. Supply squeeze incoming? Question mark. LBMA's physical silver reserves are critically low. TD Security reports only 155 million ounces of free float silver remain in London, the lowest in recorded history. That's not a typo. The vaults are drying up. Exchange for physical and OTC markets are dislocating. Silver lease rates are spiking 6% plus. Premiums are widening. A perfect storm is forming in both the COMEX and London. OTC is getting dangerously tight. This isn't normal. China's top coin market is going into overdrive. At Beijing's Madian market, dealers are suddenly buying back Panda silver coins in mass after decades of just selling. Why? The 1983 27-gram Panda now sells for $239,888 USD dollars. That's $27,634 per ounce. Speculative capital is flooding in. Retail and institutional money are finally noticing silver's setup. Tight supply, high industrial demand, no excess mining capacity, ridiculously cheap compared to gold. They're buying. And FOMO is real. Tariffs and geopolitics add fuel to the fire. The US just slapped a 30% tariff on silver from Mexico, and the EU, who supply over 25% of US imports. This could trigger a supply chain panic and price spike. What does this all mean? We're not just looking at a price rally, we're witnessing the early stages of a structural breakout, one that could end decades of suppression. So physical market is on fire, inventories are vanishing, demand is surging, geopolitics tightening supply, price finally reacting, and silver awakening is real. Are you positioned? Yeah, I am. I'm all good. Of course, I'm positioned. But I've been sitting in it for a little while. It's not, I didn't just come to this party. I've been pre-gaming for a while, boys. Been pre-gaming in the silver party. Arctic. China imported 106 million tons of iron ore in June, which is plus 8% month over month, plus 9% year over year. This brings year-to-date volumes up to 592.2 million tons. That's minus 3% year over year. The rebound in monthly volumes is attributed to higher export shipments from miners and a need to push for shipment targets. And that's all I've got for today, guys. So that's where we're going to end it. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. Special coupon code if you'd like to join. And that's all I've got for today. So we'll catch you next time. This is Finding Value.